Welcome back to the Neuro Finance Masterclass. This is day 104 of your 365 Days to Financial Freedom. I'm Ibrahim, and man, my co-host and I are absolutely pumped for this one. Today, we're basically building a time machine. We're going to master discounted cash flow, or DCF, and finally unlock the secret to calculating absolute intrinsic value. This is the exact moment we stop guessing and we start calculating.
So, here's the tactical syllabus for today. We're going to hit the ultimate truth, unpack the time value of money, build out the 3 DCF pillars, find the margin of safety, and finally wrap it up by showing you how to master the market cycle. Let's just dive right in.
All right, starting with part 1, the ultimate truth. This is all about entirely detaching yourself from the absolute madness of the stock market.
Look, yesterday, on day 103, we talked about relative valuation. But today we are throwing the market's opinion completely out the window to find absolute, standalone intrinsic value. Warren Buffett, arguably the greatest capital allocator in history, hit the nail on the head. He said, "The value of any business is the discounted value of the cash that can be taken out of it during its remaining life." Guys, this isn't just a casual opinion. This is elite-level Wall Street philosophy. The ultimate truth is that a business is purely worth the cash it generates, mathematically adjusted for time. That's the baseline. Which leads us straight into part 2, the time value of money, or as we like to call it, the actual physics of wealth.
To build a real DCF model, you've got to wire this concept deep into your neuro fitness. Think about it. If I offer you 10 grand today versus 10 grand in 10 years, you're taking it today, right? Every single time. Why? Well, inflation for one, which we covered heavily back on day 67, plus there's risk and of course opportunity cost. You could invest that money today and actually grow it. Because of all those factors, a dollar today is always, universally and mathematically, worth more than a dollar tomorrow.
And that brings us to the absolute core of the engine, the discount rate. If you analyze a company and figure out, hey, they're going to make $10 million in profit 5 years from now, you literally cannot count that as $10 million today. That breaks the physics of wealth we just talked about. You have to mathematically shrink or discount that future cash back to its present-day value using a specific percentage. And that percentage is your discount rate.
Okay, let's move to part 3, the 3 DCF pillars. This is exactly how an architect builds a fortress business.
So how do we actually build this model without relying on the chaotic stock market? Well, step 1 is the forecast period. You look at the company's free cash flow. Remember, that's the ultimate metric we mastered on day 90, and you project how much cold, hard cash the business is going to generate every single year for the next 5 to 10 years. You do this based on a realistic growth rate. You're basically mapping out the immediate future. Then, for step 2, we apply the present value formula. This is where your discount rate steps into the spotlight. In corporate finance, this rate is usually the WACC, or the weighted average cost of capital. Simply put, it's what it costs the company to fund itself. It acts as our hurdle rate. We use this interest rate to actively shrink those future cash flows, pulling them backward through time, year by year, to figure out exactly what they're worth in today's dollars.
And finally, step 3 is the terminal value. Look, we can't accurately forecast year-by-year cash flows into eternity, right? It gets way too unpredictable. But in theory, a genuinely great business lasts forever. So we calculate a single massive lump sum for all the cash the company will make after year 10, using a highly conservative, permanent growth rate. Then we just discount that giant lump sum back to today exactly like we did with the early cash flows.
All right, part 4. The margin of safety. Let's find that fair price. By adding the present value of those projected cash flows to the present value of your terminal value, and then dividing by the number of shares, boom, you have unlocked the absolute fair price. And this reveals your ultimate weapon as an architect, the margin of safety. This is the massive, beautiful bargain gap that appears when a company's true intrinsic value is significantly higher than its current temporary stock price. This gap is your literal safety net against being wrong, and it is your springboard for massive wealth creation. Let's look at this in action. If the current stock price is $50, but your objective, unemotional DCF calculation shows the intrinsic value is actually $80, you have a massive bargain gap, a huge margin of safety. This is an aggressive buy scenario. It is the perfect example of how disciplined math outsmarts the emotional market every single time. But what if we flip it? Say the stock is trading at a sky-high $120, but your math proves without a shadow of a doubt that the intrinsic value is only $60. That is a speculative bubble, pure and simple. The market isn't just being optimistic, it is actively hallucinating. But as an architect, you see the math-defying madness for exactly what it is, and you simply walk away unharmed. You don't get burned because you did the math. Which brings us to our final section, Part 5, Mastering the Market Cycle Through Tactical Deployment. It's time to take this theory and turn it into actionable strategy for your neuro fitness workout today. Look, you don't need to build a massive, complicated Excel model from scratch right now. Just go online, find a solid financial calculator or a platform that has an automated DCF tool. Pick a highly stable, cash-generating fortress of a company. Compare its calculated intrinsic value right against its current trading price. You are going to be amazed at how hilariously the market misprices these assets during moments of widespread panic or ridiculous hype. So, I'll leave you with this final, empowering question. Are you gonna keep guessing the price, getting whipped around by the crazy emotions of the market? Or are you gonna calculate the future, drag that value into the present, and absolutely rule the cycle? Stop guessing. Anchor yourself in absolute mathematical certainty. Find your margin of safety and take complete control of your financial destiny. Until tomorrow, architects, keep building.